All right, we're back. It's August and we've just seen a mad rush to self-managed super funds for people looking to purchase residential property through limited recourse borrowing arrangements. I'm going to hand it over to Jayden. He works a lot with people using self-managed super funds to purchase assets, and also probably winds a lot of them up as well. But talk to me about the mad rush that we just saw. Why did we see it? Why were people doing it? What are the problems with it? And how does the landscape look now?
Well, what a fantastic social experiment. You take something away from people, you put a bit of time pressure on, and boy, do we want it. So yeah, obviously we know budget. Greens joined forces with Labor to push through some of the proposed changes through. To get that over the line, one of the things that the Greens wanted included was basically not allowing people to buy residential property through self-managed super funds. So for most people to do that, you needed what's called a limited recourse borrowing arrangement. In simple terms, you're just borrowing money in your self-managed super fund to buy a property. So the changes that come in and finalised the 10th of August was you can no longer buy residential property using borrowed funds in a self-managed super fund. So yeah, over the last 45 days, you've seen a rush of people trying to get their ducks in a row. I don't know if there's been any undue influence from anyone in the property industry saying, playing on these biases, say if you don't do this, the loophole's going to be closed forever. Yeah, been a mad rush of people setting up SMSFs, engaging buyers agents, borrowing money, buying a property.
Obviously, for us, we don't set up self-managed super funds. That's an accountant's role. But for people with the structures in place that were already shopping, was that something that you've actually seen either firsthand or with a client? Do you still think people set up self-managed super funds to purchase property without debt?
Yes, it'd be a pretty rare case. I mean, you usually see people buying property inside self-managed super funds. One is younger people trying to get their foot on the property ladder, even people in their 50s who understand leverage and will kind of do anything to maybe make up for lost time. So they understand, look, I've left things late. I haven't contributed to super. I haven't built an asset base, so I need to do something now to try and catch up. Outside of those people, they're the ones, that are typically buying properties in SMSFs with debt. The ones that aren't, just people that love property. And you've got a lot of cash in an SMSF. I had a client a few years ago, just didn't want to invest in anything else other than property. Like, you just could not talk this guy out of it. Just wasn't happening. He was going to buy property and he had the cash to do it. So someone like that, who's again pretty rare, he will probably still be buying property in an SMSF. I think really important that this only applies to residential property. It only applies to borrowing to buy residential property. So you can still borrow in an SMSF to buy a commercial property as an example, and you still can buy residential property with cash. So there's still going to be people doing it, just not the volume that we've obviously seen. And again, coming back to the reasons for the changes, again, I think it's a net good thing. I think property is a productive asset class. I don't think people really should be playing that game. They do anyway because that's the way the rules are written. You can do it, and people made a lot of money doing it. But yeah, 10th of August, not going to happen anymore.
Yeah, great point. And depending on someone's philosophy, like my philosophy, have a self-managed super fund for full disclosure here. But for a lot of people, for 99% of people, their superannuation is their retirement nest egg. It is their safety net, so that once they get to a certain point in their career, if their health fails them and they physically cannot do their job, they have a nest egg there that their employer put into that was invested with minimal effort whatsoever with an industry super fund, just for argument's sake. There's something there for them. But if you start to play that more actively managed game, set up self-managed super funds, invest your own capital, whether it be property shares, whatever, there's more responsibility involved, and the stakes, aka having no nest egg, are higher. Now, Sam, I'll pass to you, right? Now, you've done a bit of work with self-managed super funds as well. Can you talk to me, for people that did just go on that mad rush there, knowing what you know about borrowing to buy property in general at the moment, what are some of the issues that you can see or things that people just had to be aware of that they hopefully were aware of when they brought it? But what are some of the things that you saw that people considered or didn't consider?
Well, looking at this mad rush into property, and everyone's obviously seen the changes, like Jayden mentioned, August 10th. So you've got, say, roughly 4 and a bit week window to find a property, get it all set up. So that's a big risk there, trying to pick a really great property within 4 weeks. And you might end up with a shit property and you can't polish a turd. So if it's a shit property, it's a shit property. And now you've just done this mad rush. You used all the setup costs. Obviously, another thing with self-managed super fund lending, you pay a higher interest rate too. So you've got a higher hurdle rate to beat going forward. And then you've got to look at your cash flow, because if you need repairs or anything on that property, you've obviously got to make a contribution, or you've got to obviously go through those tax obligations, moving money around. So that's another consideration. I just think in a 4-week window, you're trying to pick a really good asset that's going to obviously help with your retirement. I just don't see there enough time to make an actual sound decision on your financial future, just rushing into it. So I think that's one thing. Obviously, there's a few people in the market that benefit if you do rush into it. So that needs to be considered as well. And sort of getting a unbiased opinion or a uninvested opinion around what you should do next. Sometimes it does make sense to go the self-managed super fund route, but there's also other things you can look into self-managed super funds. You can obviously look at, like we're about to talk about, the GHHF. You can look at an internally geared fund. You can still look at ETFs. There's a range of things you can still look at going forward, and commercial property is still on the cards as well there. But with commercial property, usually leave a lot higher balance to sort of get into a good asset. You need a lot more funds to sort of make it worthwhile. But some people setting up self-managed super funds with $100,000 in there, it kind of doesn't really make sense.
Yeah, I'm just thinking as Sam's talking, like it's just for some people really crazy that they rush into it without crunching the numbers, because we've done it for many people over the last 10 years in my case, because, Australia's got affinity with property. We all know that. And some people get sold the dream around, well, you can own one in your self-managed super fund. Everyone hates super. They think people change the goalposts. They don't understand shares. It's very esoteric. We don't like things we don't understand, but property we all understand. And just thinking about, some of the modeling we've done for clients over the last few years in particular, where pro property, lay out the numbers, maybe you're with Australian super at the moment, maybe the option you're in's averaged 8.79% per annum, and you've had to do nothing. Like, you didn't even know you had it. You didn't even know where it was. Your employer's just putting in money into it each year. We'll do all the analysis. We'll look at the costs of the property, expected costs of the SMSF. And it's like, look, just to beat what you're doing now in Australian super, even with the leverage of property, this property's got to do 9.6% per year or something like that. And I know the average rate of return for an Australian residential property is like 7 or something like that. So not only do you have to find a very, very good one, you've also got to manage all the stuff now with your SMSF as well, where your other one was,
set and forget.
Yeah. And then, conversely, we've got lots of clients who have done this really well, particularly the last 6-7 years. The same's true of shares. It's had a remarkable run since probably 2008. But you look at since COVID in particular, and you've got people that have been able to get 22% per annum returns, where they just like look at you and be like, 9%, not a drama at all. Okay. But I think the point is, with the compressed time frame to get something done, people are just getting sucked in.
Dream that's probably not really in line with reality, I think.
Yeah. They're just playing on all these biases that we mentioned, and people need to act quick because the opportunity is going to be lost forever for them. So there's a lot of things to consider, but I know, like us, obviously, we've done the work with other people for however many years. So we kind of know what those outcomes look like and what you need to do to make this a viable
You sort of look
option.
at the numbers, and you can sort of just see, just after doing it for repetition, whether this is going to stack up or not. You can sort of just look at the numbers and go, well, we can model this out, but I'm 99% sure this is not going to stack up.
No.
But we'll show you it. And if you still want to go down that path, well, we can go down that path. But as long as you're aware and you're aware of the trade-off and the risks and the pros and cons, we can do it.
Big difference between somebody that has the ability to purchase a property that is within an hour's drive of a capital city, just to pick a random thing, versus somebody that is got a balance of $80,000 and their only option is Mount Isa.
Yeah.
Okay,
The setup costs are like $5,000 and you've got 80,000 balance. Like,
completely
make sense.
different outcomes. And you both touched upon great things there. So I'll just pivot to something you said there, Sam. Interest rates are higher. So a lot of the time people are borrowing starting in the 7s at absolute minimum. So if we're borrowing at 7% or more, we obviously want to be compensated with extra growth. So we need to be able to make sure that we're buying the best asset that we possibly can. We don't really want to be borrowing money at 7% and having something that's going to come in here and compound at 4, for argument's sake. Okay. It just wouldn't be worth the headache. And then conversely, Jayden, you work with a lot of business owners, as we're aware. Can you run us through a scenario that you've used a self-managed super fund for a client that owns a business, and give us sort of doesn't have to be a specific client, but just a general scenario where, no, it might not be residential property, but it might be something else that they've purchased that's really helped them and align with their goals and their business.
Yeah. Look, one of the main ones with business owners, they've already got accounting relationships. They're used to doing tax returns, financial statements, being organised, BASs. So that typically means they've got the capability to take on the role of director or trustee of a self-managed super fund. So that's the first thing. If you're just a PAYG employee, never had any of that responsibility, for me, it's a bit, well, you've never done this before. You don't have that relationship already. Something we've got to consider and talk to them about. But yeah, with the business owner buying a property in the SMSF, obviously commercial property is a big one. People that run businesses have a need for a factory, warehouse, whatever it is. It's always a big draw card to them that, hey, I can own this and I can pay rent to myself, being my self-managed super fund. One of the ones that comes to mind for me is, this is going back a few years, but we did have a business owner family. They had a couple of commercial properties. They weren't huge in value. They were in a more regional town in New South Wales, but they hadn't really contributed a lot to super. And one of the things that we spoke to them about initially was, well, why don't we potentially look at putting these properties, well, they've still got a relatively minor capital gain. It was basically nothing. You would have to incur some stamp duty, but putting these properties into an SMSF, because then we also spoke about, look, if you do get some capital gains tax or some capital growth on these properties, you can hit 60, retire, and if you sell them with your business or whatever it is, you can sell them tax free. So there's obviously that big draw card, but then also, they're now paying rent into their self-managed super fund as well at the same time, using that rental income and all their other contributions at the moment to also diversify away from those commercial property assets. So, these guys from about 4 or 5 years ago had collective balances of maybe 250 grand inside super. Now they're at like 1.5, pretty quickly. A large portion of that was putting these 2 commercial properties in there, but with the rent, the growth, the contributions, they've got it up pretty quickly. And as we know, for anyone in Australia at the moment, as of age 60, if you've retired or changed jobs, you can have $2.1 million in a tax-free phase. So it's a pretty big draw card, I think, a pretty big opportunity for people to take advantage of. And if you're a business owner, there's that additional carrot of, owning your own premises. Caveat on that is these guys already had these premises before we met them. It's still got to be a good investment. It's still got to be an efficient use of your capital. Because if it's not, I still think you're better off paying rent and putting your capital into something that's going to earn more over the long term. So, that's an example that we've seen. We've seen other people look at it. We've seen other people discount it for the reasons I just mentioned. Got a client in Darwin that looked at it and it just didn't make sense. But we've got other clients that have bought properties as well in Melbourne to run their business out of, and that's doing pretty well at the moment. But that's the main one, business owners buying their commercial premises.
Yeah, you make a great point there that the metrics of that investment actually have to stack up. Just because you're currently renting at this location and the commercial property next door has popped up for sale and the bloke, so you can get it nice and cheap and run it through your SMSF and pay yourself rent, it doesn't mean that that asset's actually going to compound and provide for your retirement. It will provide your business with security. You're not going to kick yourself out. But at the end of the day, we still need that asset to compound and then eventually sell it tax-free. Now, a great thing that we talked about before, really high level, obviously Sam gave us some points around how it doesn't stack up. For people that took their time, had the right team around them and brought a really good quality asset before the deadline that we're right on the verge of hitting, those people are going to have a great advantage, right? Their employer contributions, or if they're self-employed, SGC contributions generally, are going to go into their fund and help offset some of the cash flow considerations with that. There's rent. And then hopefully if they bought a really good quality asset between now and retirement, at retirement, they're going to sell that CGT free. Obviously, there's other considerations there, but comparing that to a flawed capital gains tax rate minimum of 30%, you can see why some people were rushing there relative to previously, where I could buy property in my own name, negative gear it for 10, 20, 30 years, wait till I retire, sell it, average tax rate well below 30%. What I want to do is talk about outside of super. Sam gave us the sneak peek here of other ways we can get leverage inside of super, but let's just park that. Let's go outside of super. Sam, the hot topic at the moment, because it was unchanged by the budget, is debt recycling. Can you run us through how debt recycling works and maybe just a client scenario of where if you saw that client, the client avatar, to use Jayden's words from last month, they're the perfect candidate for debt recycling?
Yeah, so a quick crash course on debt recycling is essentially just turning non-deductible debt to deductible debt. Now, one of the quickest ways to do that is just say you have an offset account. Say you've got a 100K park there, you've got a 500K loan. Say you pay that 100K into that loan and then basically redraw that money back out and then go, say you invest in an investment portfolio. Well, now you've got the same position there, same debt position, but you've churned 100K into deductible debt. And now you've got an asset here growing alongside your family home, for example, that's now tax deductible, that 100,000. So obviously you just rinse, repeat that scenario until basically all that home loan debt that's non-deductible is gone. You've secured the debt against the home, but it's what actually you did with the debt. Now, if you go out and say you've got a significant amount in the offset, pay it all down, withdraw it back out, go get an investment property, you could do it that route too. But one of the things I always notice, best way of debt recycling is building up that offset, offsetting those non-deductible debt, getting your mortgage broker involved, catching up with your advisor, having those discussions around what's your cash flow look like, what's lifestyle look like, if there's planned any, say, renovations, you've got kids schooling to consider, holidays, a car upgrade, whatever it might be, consider that as well. And then looking at, well, what do we do with these funds? Do we pay it down? How much do we pay down? Where do we invest that money? Those are just some things to consider. But with debt recycling, it's a really good way if your borrowing capacity is capped and you sort of don't have any more left. Well, this is another way we can set up an asset that can also grow on the side.
Yeah, great point. And from my perspective, it's a way where somebody that doesn't have the monthly cash flow to afford a property, it's a way that they can simultaneously pay down debt, save tax, and invest.
No, it's a beautiful strategy. It's
S tier. I put it in S tier.
yeah.
Top tier strategy.
I mean, the one thing with the debt recycling, as we spoke about last month, was, one of the main draw cards of property is just how much leverage you can have. I mean, that's effectively what's driven property to probably overall be a better asset class than shares, just purely because of the leverage and not the asset itself. I mean, that's the main drawback, but it's also probably the main benefit of debt recycling. You can choose, maybe I'll start with 50 or maybe I'll start with 800 if you've got the equity in your property. Yeah, but I mean, like you're saying, I can start earlier in my investing journey. I can at the same time pay off my home loan and then also get a tax break. It's like, nah, what's this? No.
This doesn't make sense. This can't be legal.
This can't be legal. But it absolutely is. So yeah, it's a great strategy, and I know one we adopt really heavily. And like to talk about that client avatar, it's like if you got good incomes, you got solid cash flow surplus because of the ability to dial up and down how much you want to borrow to kick this off. You've got a home loan that you're trying to pay off. There's not many people that this strategy doesn't suit. Like I've got plenty of business owner clients where they're spending a lot of their surplus income or the amount they're drawing out of the business, but because they've bought homes or properties and they're just creating equity, you're just really putting that equity to use and borrowing the bank's money to do it. Like there's really no reason not to do it.
Exactly right. It's arbitrage. If I can borrow money at 6% interest only, claim that on tax because it has no affiliation with residential property, it's still completely deductible post-budget. And let's say I'm in the 45% tax bracket. When we look at the real rate or real cost of that borrowing, if I can take that money and then go and make 10% for argument's sake or even 8%, the compounding effect of that. And a great thing that I just want to touch on here is people need to remember the word recycling in this. It's not just more debt because we're not going to buy, or you can, but it's not true debt recycling. You're not taking equity out of your home to go and buy a property with a net yield of 2%. That's not debt recycling. That's just using equity in the home to invest. Debt recycling, we're actually going out there and we are buying an asset, just to use Sam's example, a portfolio that maybe provides us with 4% in dividends, right? I can actually then go and take those dividends and then that will accelerate the rate that I pay down my non-deductible debt because it puts cash in my pocket. And you made a great example before. You were just talking about super funds generally, but you talked about Australian super. Simplicity is key there.
Yeah.
And a great thing about debt recycling that we harp on about is you can go and buy an asset with your 200, 300, 800,000, whatever it may be, and you can just go to work. There's no land tax. There's no agents. There's no tenants. There's no insurance. There's no headache. And if I need my money because something in my situation changed, you can get your money in 2 business days after your trade day.
Yeah.
So what are we talking about? No administration fees on a lot of platforms as well.
Can be simple. Depends on the person and if they're going to have their portfolio on their phone, be checking it every day.
That's another
I
problem.
mean, it won't be simple.
I need that KISS strategy. Keep it simple, stupid.
Yeah.
I love that strategy.
Need to delete the app. Don't give them their login details. See you in a year.
Yeah, just check it once a year. That's all you need.
Exactly right. Now we're going to get into client scenarios. So we're going to play a little bit of a game. We're going to get one of the advisors to run through a random client scenario that they can think of. They're going to ask the other 2 advisors, high level, how they would help or how they could help. And then the advisor is actually going to finish the question or scenario with how they actually helped. So we'll start with Jayden. He's going to give Sam and I the scenario. I'll let Sam go first and explain how he would help or give an idea. I'll answer, and then Jayden.
So One family that comes to mind, we've been working with for 3 or 4 years maybe. When we first saw them, they actually came from another advisor, both high income earning. I'll talk about their circumstances specifically today, but back then they were both high income earning, were saving about 2 to 3 grand a month, which this advisor was just putting into an investment portfolio. 3 kids, none of them had started high school at this point, but they wanted to send them to private schools, not necessarily $30,000. They weren't quite sure on all of them, but at least 10 to 15 grand. So they had some expenses coming up. And they got bonuses, a couple of things that were really important to them. They live in Sydney. They wanted to own their own home. I still remember the husband said to me, wanted to turn the rent tap off, were his exact words. But the place they wanted to live in was probably back then even $2 to $3 million in Sydney. Very close family together. They valued fun. They wanted to travel each year. That was a big thing for them. And typically what they did, they used their bonuses if they got them each year to go somewhere. So initially what we did upon, just setting the strategy, the main change we probably did is we said, look, if you can save this amount of money per year, they actually used one of their parents as a guarantor. They went and bought an investment property through a buyer's agent in Perth. Bought that for about $780. It's over $1 million now, so just about 3 years later. And then, recently they've received an inheritance of about $1 million. Okay, so they've actually been in jobs. They've both changed jobs once or twice. Gross household income before bonuses is between about 480, 500K. So they are earning good money, but they're not actually saving much at all at the moment. They've got the property that's still negatively geared. The kids are in the schools at the moment, so there's not much savings at all. Super balances are about 900 combined, but the wife has a much higher balance. She's 600 and so, 650. He's got about 250. He's got some carry forward space, so about 30 grand left in carry forward space. They've got all their insurances. They've always been really committed to that. We don't do their insurances, but work with the life insurance advisor to keep them up to date and relevant to their circumstances. So all their goals were still relevant. They'd actually changed their priorities. So 3 years ago, their highest priority was getting into the family, or it wasn't even the family home because the place they wanted to buy were post kids. But their main priority was now having cash available, and it was still 30 grand budget to travel. That was the main one that they wanted to make sure that they could use this money to achieve, given that there was very little surplus cash flow without bonuses. Happy to keep working till 60 at a minimum, potentially even 65, depending on how things went. I think that's pretty robust summary of where they've come from and where they are now and what they're still looking for.
Just touching on everything Jayden's just mentioned, you've got to look at it from a few factors and what sort of pieces we can add into their strategy and as well as with their plan. So obviously you mentioned the $1 million inheritance, the equity's grown in the investment property. They want to still be able to travel. Obviously cash flow's tight. We've got school expenses. They want that travel budget. So you'd start looking at from that investment property is probably out of the picture, possibly, just given the cash flow's tight. Do you want to park those funds to obviously help fund that investment property expenses? So you'd probably look more at the investment portfolio and what we can sort of construct from that side, making sure we've got that emergency buffer there as well. If they do need it, is what I'd be looking at. And then looking at possibly even an internally geared ETF for the investment portfolio be one consideration, and sort of how do we fund that fund budget, as what they call it. So obviously things have changed as well since 3 years ago from the budget standpoint, where property is probably not as favourable as it was once. So that's another thing to consider.
The investment properties in joint names, so they're both getting a tax deduction because it's negatively geared at the moment. But I had the conversation with them too. Their buyer's agent that they work with was, obviously they went to him first actually before they spoke to me about the inheritance, and he said, we're going to buy 2 more. So when I spoke to him and, we uncovered a few things, how their priorities had changed, and the main one was the travel budget. Even with $1 million, I failed to see how with $1 million, we're going to be able to find some properties that were going to give us a 30 grand guaranteed after tax cash return.
And sinking money into property to get the rental income, I think is pretty, backwards looking. Like you can get a 4 or 5% yield on a term deposit if you want rental income. Like it just doesn't make sense. You buy for capital growth at the end of the day.
Yeah, agree. So
I just think people that are chasing income and retirement or whatever they're looking for income, I think property is not it for income.
Yeah. So, that was a conversation I had with them early on. I gave my thoughts on it and they agreed with me pretty quickly. One thing just to call out, I've always felt that advisors inherently have a bias, because if we're investing in property, well, what's there for me to do? That's never been the case with these clients, because there's been a lot of strategy, a lot of conversation. They've got 3 kids, they're very busy. There's a lot going on. They're changing jobs frequently. And I've never felt that. And if that is the case anyway with some clients, that's fine. Well, when your circumstances do do change and you feel like you need more advice, we'll still be here. But yeah, having the conversation with them about their circumstances, I felt really comfortable that it wasn't a biased decision from me to say, well, here's an extra $1 million that I can invest for them. It's actually, no, for these reasons, genuinely, property doesn't feel like it's the right strategy for you guys right now. I can't confidently lock that money up and say we're going to achieve this goal of having 30K for you guys to be able to take the family away each year while the kids still want to be, with you guys and doing that sort of
Can't
stuff.
sell that bathroom to fund that Euro trip.
Yeah, that's right. So that was a conversation we had and kind of ruled out property from there.
To dive deeper into a few things, so I'll come back to the inheritance and I'll just stay on the flavour of a property. Under the new rules that we're all currently playing by, I'd rule out property exclusively. As you said, not buying a residential property for income. It's just not the right play. Depending on who you talk to, how much growth is left in the Perth market, I'd probably just keep my finger on the pulse there and see what's going on. I'm not selling a property just because I think it's going to, finish its cycle in 2 years. Like, let's actually just wait and see and monitor the data. I think the two biggest levers for these guys to pull, the first one is the inheritance. And you guys just talked about goals, but goals first, strategy and structure second, investment third. The biggest thing for them is they're both top tax bracket earners. There's a household income of $500,000. I think they'd be crazy to invest that capital in their own name. So the first thing I'd go to is an entity. Now, I'm not going to go to a trust because the capital is just going to have to flow back straight back to them. So I'm probably going to look at a company setup. They can put the money in there. It's going to be taxed up to 30%. The money can just stay in there and continue to roll over. Yeah, they're not going to have great freedom to go, 1 year we're going to pay person X versus person Y. It's got to come out in proportion to their shareholdings, but it's a great way that they can just store the $1 million in there until they're ready to pull the trigger on their eventual family home. They continue to build up. There's franking credits and things of that nature, but we come up with a strategy there. Sam did touch upon a point of internally geared funds. You could have that conversation as well. One thing I think that's sort of been glossed over a little bit is you said one of the people in that couple has carry forward concessional contribution space. Now, some people go in there all guns blazing and go, I want to use that straight away. For me personally, I'd just be looking at what is actually going to expire when we roll into another financial year in circa 10, 11 months time. Because if I go and use that now and then the property in Perth, the data really does start to flatten out, like Perth did go through pre-COVID, but the data there flattens out and they go, hey, now we want to pull the trigger on our property. The only way for them to save tax on that property when they sell it is to put money in super. Now, if that person is still well below $500,000 and not looking like they're going to hit it any time in the next 5 or so years, if their space was from recent years, which I don't think it would be, but if it was, I'd look to save that gunpowder dry. Alternatively, I would just use what's going to be lost. But investing the inheritance in the right structure and then really looking at those super contributions, assuming outside of that, they're maximizing their general concessional caps regardless because they earn a mozza. And then from their own personal standpoint, assuming they got the right buffers in place and they're ticking those goals, yeah, they might not be able to save a lot. But if super's ticking away, the property's ticking away, and a bucket company with $1 million is ticking away, I'm not too worried if you can't save a lot in your own personal name because everything else is ticking away. Go trouble.
And touching on what Jayden mentioned about that fund budget and stuff, and if their bonuses don't come through, well, at least you've got that investment in that company structure that you can take that little bit of funds if you do need a little bit of a top up to fund that holiday. And that's something, obviously, that's important to the client at the end of the day. So you've got that flexibility there if you need it.
Yeah, I mean, really good points as well, Riley. So with the catch-up contribution space, they were from a fair while ago. But the other unique thing about this person is with where their incomes were at, he was just slightly on the lower of the two in terms of income, and he was uniquely placed to just earn under $250,000 for the year. So he was in a pretty sweet spot where, and just so those listening, if you earn over $250,000 a year, including your super contributions, you pay what's called Division 293 tax, where your effective tax rate on your contributions to super is 30%. Now, it does depend on how much you earn over 250 as to what or how much of your super contributions you pay tax on, but just for simplicity, let's say it's 30%. He's also on the highest marginal tax rate because he's over 190. Okay. So in between this sweet spot where he's not paying Div 293, but his income's over 190, he puts money into super, he gets a tax deduction at 47%. Inside super, he's only paying tax at 15%. If his income went over 250K, he's still going to get the 47% tax deduction personally, but he's now going to be paying 30% on his contributions to super. So the benefit of that strategy goes from 32 down to 17. So although he also had he had to use this space the majority of it. I think he had about 23 from a year 5 years ago, and then there was like 7 and some change from the previous couple of years. For him, using that last financial year was going to provide a 32% benefit, which we couldn't be sure of would exist moving forward because he was likely to be paying Div 293. So for me, using about 30K of that $1 million to come in to maximize his super contributions was just like a no-brainer. It basically saved them about 10K in tax.
Nice little tax return.
Yeah, which they'll get some stage this year. That'll be nice.
Fun budget.
Yeah, so we did that. Yeah, now exactly right on the alternative structure. Why would you invest close to $1 million? They also needed a bit of a top up to an emergency fund. We worked it out because of their expenses, debt as well, that they needed about 60 to 80K. So we landed on 60 because we also weren't investing the rest of this money in a property. So there's still going to be a lot of liquidity left in their funds. But once you took that out, there's about 900K to invest, and we invested in a company. Now, you mentioned before taking some money out of a company. Now, one of the issues with that is if you take the money out of the company as a dividend to meet this fund goal, they're on the highest marginal tax rate. So to get them roughly their 30 grand, you need to be taking 60K out in income a year to meet it after tax. So what we've done, the way we've structured is the 900K when it goes into a company, it's actually a loan from them. So it's a capital contribution into the company. So when the 900K is in the company itself, let's say they got 5% income return, they're not going to pay tax on the growth, but let's just say 5%. So on the 900, they've earned a 5% return in income, which is 45K. That gets taxed at the company tax rate. We're not paying that out as a dividend. We pay that 30K cash out as a loan repayment of the 900K that they originally put in. So as a loan repayment taxable income to them? No. So that was one of the other strategies we did is we could get this money invested in a very tax effective environment. So they're paying tax on the income at 30%. They won't get the capital gains tax discount. They're going to be the joint shareholders. We may introduce a trust to be the shareholder eventually. It might come at a small cost in a couple of years if it's warranted, depending on how the investments go the next few years. But for these guys, they're going to get the 900K invested in a very tax-effective environment, and they've pretty much got 900 grand worth of loan credits that they can repay over the next 10 to 15 years till they access super to basically get their money back out of those earnings tax-free to them. So we've modeled this out again. They're going to be able to achieve all their goals. And they're going to retire somewhere between, if they choose to, 60 and 65, being able to access super as well. It's just what's the house they want to live in 10 and 15 years. That's the unknown, and that's really going to be dictating how much longer they have to work after 60. So
I love it. Very comprehensive, but you've made it sound so simple there.
Didn't get into the investments either, but that might be a whole nother story, how we invested their funds both in super and in the bucket company. So
we'll have to add that to the discussion list for next month. Now, I've got someone in mind, and Sam, you're the retiree specialist. So I'm going to give you a scenario, and we see this fairly common, right? Well, it's quite a common scenario, but it's really for anybody listening at home going, is this me? Okay. Now, I'll let you run through what super death benefits tax and things like that is, but I have had somebody, let's say we've got 2 clients. We've got just quintessential husband and wife couple. They are recently retired. Let's say they're 61. They're retired at their 60th birthday. They're the same age. They've completely out of there. Combined super balances, $1.5 million plus. Just a touch over is what I mean by that. But they have a fair amount of investment assets outside of the superannuation environment. Now, they have 2 adult children, of which are married and have their own children. And they've come to you as a retirement specialist for advice. They pulled the trigger on retiring without advice. They now look at their situation, what they've spent in their first year of retirement, and they're starting to think, did we pull the trigger too early? But also, what do we do with the capital that we have or the capital that we may receive in the future from inheritances? So I'll pass over to you to give your thoughts.
Well, it's not an uncommon scenario where someone's pulled the trigger on retirement and then they've come to you for advice after the first year and gone, what have I done? So first of all, you want to look at, well, what are they actually spending in retirement? What do they actually need to fund in retirement straight away? What's their cash flow? Do they need, say, if it's $100,000 a year to live off? All right, that gives me a good ballpark figure. And then I sort of work back from there. So straight away, looking at from obviously adult children is a factor we need to consider when we're looking at, well, their super balance, what happens to from an inheritance planning perspective is if these funds do go to their kids, what's the implications of that happening? So then I'd look at as well, what's the investment assets outside of super? I'm assuming they've probably got some blue chips or anything like that they've held for 20, 30 years, massive capital gains. How do we manage that? So straight away, we want to look at their super as well. What's the taxable components and tax-free components? So with superannuation, it's made up of 3 components. Now, I'm not going to keep this real high level. So you've got 2 components that attach taxable components that if they are paid out to, say, adult children, for example, it does come with what we call super death benefits tax, and that can float from anywhere from 15 to 30% plus Medicare levy. So if you have $1 million and say it's a 15% tax rate plus Medicare levy, you're looking at, say, $170,000 paid to the ATO if you've got $1 million that goes to kids. So usually people don't want to pay more money to the ATO than they have to. So straight away, there is strategies you can put in place to sort of minimize that or really completely wipe it. It's what we call a recontribution strategy. Essentially, you pull the money out of super, then put it all back in. But there is contribution limits that come with that too. So right now for this financial year, you can put up to $130,000 as a concessional, but then you can use what we call bring forward rule and bring forward 3 years worth. $390,000 for a non-concessional bring forward. So with that, you can pull up to nearly $520,000 as a non-concessional into super, and then that forms a tax-free component. Now, one of the tricks here, if just say you do have a super fund that's got $1 million in there, you want to sort of rinse the taxable components out, or you don't want to put that non-concessional straight back into your super fund again that's got the leftover funds, because then you're going to contaminate that fund and it creates another headache for yourself. So you want to contribute that to a separate super fund or separate super fund account. And then with that, you want to start the pension there with that, take down the minimum, but then say you've got this other funds here, I consider it like a dirty fund. You would start that again and draw down more from that account. So if you just say you draw down the minimum here and you need to pull the extra from the dirty fund, you'd obviously structure it that way. And then a couple of years' time where you can obviously recontribute that strategy, or you do it again with the dirty funds. But then touching on the investment assets, well, then you want to manage the tax side of those things. When you're selling down to creating those sort of taxable income, well, then you want to look at super contributions and using concessionals and what sort of tax benefits you can get from that. So those are just a couple of things to consider as well. Looking at that strategy, managing the investment assets, selling down, and then obviously managing the recontribution strategies along the way, and just having that balancing act on what do they actually want to do in retirement. But then you also want to make sure you're maximizing the amount you can have in super, which Jayden touched on, which is 2.1 million in an account-based pension. So as a couple, you can have up to about 4.2 million in there. And just say, for example, that earns, say, just for round figures, 10% return, 4.2 million, that's 420 grand you can pull out tax-free. That's great. That's a great tax outcome. So those are just some things I'd be looking at and considering from a strategy standpoint.
Yeah, some great points there, particularly around segregating the tax-free money once it goes back into super. Jayden, do you have anything to add here about the retiree couple?
I think for clients in this position where they've, pull the trigger potentially too early and double guessing themselves, is one of our jobs isn't necessarily just as the advisor, it's also the guide. So just really mapping out what their position is, how that looks like over their expected lifetimes, and how they can structure their affairs in a way that's going to reduce certain risks. So we know sequencing of returns risk is a really important one for people in retirement, but there's also a lot of tools that we use to help clients mitigate those risks. So you've got a retirement spending plan that you can talk to clients about. So in years when you get poorer returns, maybe you dial back your spending. And that's one of the things that you just have to cop if you haven't really planned this really well and you pulled the trigger too early and maybe you're not willing to go back to work or something like that. You can also implement bucketing strategies for your investments. There's pros and cons to doing something like that. But I think just really modeling things out, helping the clients understand their position they're in, what their options are, talking them through all them. Yeah, just giving them all their options so they can make a really informed decision around what they want to do about their future. And we've got clients that, despite all this and you're going to run out of money, that's fine. We'll survive. We'll get to the pension and that's our fallback, and we'll go from spending 3 times that to,
Chicken feed.
to chicken feed. And that's fine. If I've never met anyone that can more than a third their current lifestyle, but that's fine. But at the end of the day, that's all we can do. You can take a horse to water. You can't make it drink. But I think our role as not just the advisor, but the guide is to help people in those positions just understand what life could look like and what their options are.
Yeah, you touched upon some great points there. We are a guide. And for these clients to round this out, that's all I treat myself as. They're the CEO of their own financial situations. Ultimately, they're the ones to make the decision. So you both touched upon some great things. First thing we did was map out the rest of their life expectancy plus 5 years. And I showed them that spending different levels, spending what they're currently spending versus trimming back versus spending about 25% more than what they were currently spending. So they could see when they were going to run out of money based on how they live their lifestyle today, right? Because we can't control the markets, but we can control what we're going to spend.
I think one thing as well with cash flow spending is in the first 10 to 15 years of retirement, cash flow spending is going to be a lot higher, and it tapers off as you get into your 80s, usually 75 to 80, that period where it tapers back down. Travel's obviously not as easy. Mobility starts to go backwards. And those are just things that we can also consider, that we might have a higher travel budget first 10, 15 years, and then we might scale that back a little bit.
It's actually a great point. And for these people, they do travel domestically and abroad a fair bit, and their travel budget was quite high, probably 2.5 times what I would say the average retiree had. So they were front loading a lot of their travel whilst their health permits. And
50 grand a year?
A little bit less, but not 50. But exactly right. So we start with the modeling. We have those sorts of discussions. The next thing that and they found really useful was we looked at, all right, they actually were paying tax on the Australian shares that they had outside of super. As I said, it was several $100,000. And it was actually owned only in one person's name. So they weren't splitting the dividends between two of them. There was a capital gains tax bill associated with those shares. But what we did was we brought in the accountant. I ran the analysis. The accountant confirmed the analysis. I looked at it from a performance perspective. And these things had not grown like you would have hoped over the last sort of 15 or 20 years, which is how long they'd held the shares. But they had provided the income. Now, we had to have a stern conversation and really just come down to the numbers. Do we want to put this money into our superannuation today, into the tax-free environment? Okay. And then if someone was to pass away, it will stay in that tax-free environment for the next person, rather than if the person who owned the shares, you know what I mean, got trapped in a formal court process and then it went to the other person and certain taxes and things like that and cost bases were inherited. Or do we want to save tax for our children? Because like you said, Sam, there are non-concessional caps. We can only use the bring forward rule, and that takes out 3 years worth of space. So we had to choose. Do we want to do recontribution strategies to save tax for our kids? Or do we want to get this capital into superannuation in tranches, for argument's sake, starting with concessionals and things like that? There wasn't carry forward space as well, so we could only live at the tax so much. So we had to control that through selling things down. But getting the funds into super for our own lifestyle, which actually helps us live more because it manages the longevity risk through diversification and other things. Or do we save for the kids? And they made the decision, no, we actually want to prioritise putting what we can into super first, using our remaining non-concessional bring forward space for the next 3 years between now and 64, 65 to do the little bit of recontribution strategy. And then we'll be 65 and we have 10 years and we can still do a recontribution strategy 3 times over. And we co-intersected that with the modelling. So once we knew, oh yeah, hey, by 75, when you can't use the bring forward rule anymore, this is roughly how much you'd have in super anyway. And if we have segregated taxable and tax-free, we just know to spend from the taxable. So car upgrades, extra travel, gifts for grandkids, all that sort of stuff, we spend it from the taxable money.
You touched on, Riley, too, around looking at the kids and do we give inheritance now or do we worry about our future? I think one thing that people always get undone by or shortchanged there is trying to help their kids too early without securing their financial future first. And that's really can come unstuck if you give away too much inheritance too quick, or you want to manage it from that standpoint, but you haven't secured your future. You could end up in a period where you don't have enough money to actually fund what you want to do in retirement. So I think number one is always secure yourself first before you help anyone else.
A great analogy for that is when you're on the plane and it's going down, you put your own oxygen mask on first. Can't help anyone else if, you've run out of oxygen as well.
100%.
But one of the things I was going to say is, an overlooked benefit of, the strategy you've recommended, Riley, is just the simplification of things. Like I've worked with a lot of people, a lot of families over the last few years who one of their ultimate goals was just simplifying their affairs. So when it come to estate planning, it was just a lot simpler. It's not often we see people come to us now with huge portfolios of direct shares. Most people are in ETFs, all that sort of thing now as well. And I've still got some clients where one lady in particular, we've got shares that she inherited from her mum. These are like 1980 Combank shares or something from so long ago. They're so pregnant with capital gains tax issues that it's not just easy to flick them all off. But one of her goals is to progressively sell them down over time with smaller capital gains tax obligations. She can't get the money into super now, but it's just going to be one simple estate with a couple of shares, a super fund. I think that's something that's often overlooked because, again, working with these type of clients, unfortunately, one thing that you do is you're then helping the estates and the executors. And when shit's everywhere, it's a nightmare. It's terrible. So I think, as I said, simplifying someone's affairs, potentially getting a tax benefit. And if you can wind things up, so literally the only assets they've got is a house, a super fund and some cash accounts,
your kids will be thankful.
Or, yeah.
You won't create a headache when it
Especially
happens.
if you've recontributed everything.
Yeah, and you're not sending the tax bill after you think everything's sweet, and then the ATO is like, yeah, give me my part now.
Yeah.
Exactly right. Not paying for tax returns and things like that as well. Now, probably a great segue into the next thing we're going to talk about. One thing we've talked about it in our business is how do people actually make decisions and build frameworks around how they're actually going to invest their money? Okay. Now, the first thing I want to mention here is some people build their own portfolios, right? And they use individual ETFs. Other people,
VGS.
exactly. And then other people will just go, keep it simple, stupid, for a lack of a better term, and just pick one thing and get on with life.
VDHG.
Exactly right. So when are you seeing it being one versus the other? When do people actually go, no, I want to build this myself? And then conversely, when they do want to build it themselves, just as a follow-up question, how do you actually decide how much to allocate to Australian equities?
Well, that's like property and shares, isn't it? It's like home bias versus, oh shit, look how well international shares have done the last 4 years. You'd be crazy to put any more than 2% into Australian equities. Coming back to your first question, let's just make the assumption that the person we're dealing with, they understand passive investment strategies. They understand the benefit of index. They're not picking direct stocks. Okay, once you've made that decision, some people I think can get really hooked on the low cost thing. And I think that's where people go, well, why would I pay 0.27% to be in VDHG when I can just build the portfolio myself with the underlying index funds or sector funds? So you can do that. That's absolutely. And you will build a portfolio that's lower cost. But I think at that point, you've also got to think, okay, what am I paying here for? Because by the same token, you can actually get a brokerage account and buy the top 300 companies in Australia, by their market capitalisation. And now we're not paying anyone any management fee except for the brokerage. So it's a cost-driven decision, I think, to build your portfolio yourself, other than I don't believe that we should have 30 to 40% of my funds in Australian equities. We only make up 2% of the global economy, and look how well everyone else is doing. So I think they're usually the things that are going through people's heads when they make these decisions. I only got anecdotal evidence, and again, I could be wrong, but what I believe is that one of the best ingredients for success when it comes to investing is simplification. And what that typically means is I'm happy to pay a Vanguard, a Beta Shares, an iShares, whoever, to manage the underlying asset allocation for me. You can make arguments for having a home bias and not having a home bias, but I think paying someone else a small management fee to make that decision for you and not staying in your portfolio and thinking about that over time and have I made the right, wrong decision, we won't know. You won't know until you're 50 and dead anyway. Just go simple, put as much you can in, and it sounds trite, but control what you can control, which is, can I earn more money? Should I be investing in a better tax structure given the changes from the budget? What are my goals and objectives? I think keep it simple and focus on what you can control. But people, think they can do it better. People think they can do it cheaper. People think they can stick to that plan as well. All power to them.
Exactly. And great point there. And it comes down to time as well. How much time do you actually have to manage this? Because the bigger the portfolio gets, the more time you have to invest into it. I'll pass it over to you here, Sam. First and foremost, what's your opinion on it? But secondly, can you expand a little bit upon Jayden's point where we're seeing some of the providers have anywhere between 25 and 50% exposure to the Australian market in these pre-made products?
I think it comes down to, as well, like Jayden touched on, around costs when you're looking at sort of that from a lens that I look at, is that returns are always going to be volatile regardless of what happens. Like they're going to go up and down, they're going to fluctuate. Costs are pretty fixed, but when you get to a certain fee compression, it's not really going to make too much difference. It's really how much more of a headache do you want managing that? Do you want to be checking to make sure you're in the right asset allocation, it's rebalancing correctly every year, you're managing that side of things? And I think that just becomes more of a headache. And the more times you touch a portfolio, I find the more chances it just goes wrong. And then you look at
investing's like a block of ice.
Yeah,
the more you touch it,
yeah, exactly.
The less there is.
And then touching on like the passive style and everything like that, like even the greatest investors like Warren Buffett just said, buy the S&P 500, don't touch it. Like if he's recommending that and he does it professionally every day, lives and breathes it, what hope in hell do you have trying to beat him? So I think, when you look at that from that standpoint, don't touch it as much. But touching on the Australian equities, I think Australian equities are very heavily weighted in the big four banks, BHP, Coles, Woolies, Telstra, a few oil companies, and that's pretty much it. Yeah, miners. So that's all you're really getting. And typically that has done well over the last 20, 30 years for Australians. Like even my own mother's done pretty well off CBA. So I think When you look at it from that lens, people have this sort of bias where they think, oh, the last 30 years is going to be the next 30 years, but past performance is an indicator of future performance. And then you also need to consider diversification as well there. When you look overseas, you're getting a lot more tech stocks. You're looking at some defense companies. Obviously, that's a bit of an issue there. Some people have a preference there. But you look at some of the companies in America and Europe and what do they do? And then you look at probably like Japan, South Korea, and then you look at the Asian market in China and stuff. So you get a lot more diversification there, spreading out your risk as well. And like Jayden touched on, 2 to 3% is the Australian share market in the world. You've got another 97, 98% there. So I think that's a big consideration there, not having a home bias. And if you've got investment properties and you're still investing in the Australian share economy, and then you're also working in Australia, like that's a lot of risk just in Australia itself. So if we do have a downturn or we have a GFC-like event, you're probably going to feel it a lot harder than someone that's a bit more diversified.
Riley, why do you think that all these major fund providers have a home bias? So, it's not just something that's in Australia, like it's prevalent in America, it's prevalent in the UK. Like any fund that's, domiciled in the local country or the economy will have a higher home bias to that local economy.
There's a number of reasons, to be honest. I'll try and keep it to sort of less than 60 seconds, but home bias is almost the reason in itself. But why do they have the home bias? It's convenience. A lot of the time too, these funds as well, like franking credits. We've had some great conversations around franking credits and income plays and things like that. They can actually go out there and analyze these companies from a boots on the ground perspective. But the franking credits can continue to pile up, right? There was obviously a famous election not too long ago where they talked about scrapping franking credits, and that was another issue there. So that would be the main ones, unless there's something I'm missing here.
Currency?
Currency risk, yeah. So we're not hedging. There's no need to do hedge strategies if you're investing in US shares and bringing the dollars back over here. So that's a great one.
People know the brands.
Yeah, people know the companies. People trust in there.
What are people typically patriotic and want to support Australian companies, perhaps? That's
maybe 10 years ago.
Yeah. Hopefully that comes back. But look, that's going to wrap us up for this session. Plenty of exciting things that were talked about. We got much, much more on the horizon coming up next month. So stay tuned for that.